Warm greetings to you, accountants. This is another presentation, and today we are doing cost accounting. And this is your usual platform, the Mascom uh, studies. So I'm encouraging you to have your pen ready now. As I get my red pen on this one, let me get a red pen so that we can work together. So this is investment appraisal. We want to concentrate with investment appraisal. On investment appraisal, it's very simple. This is a cost accounting, cost management accounting, where we are assessing the viability, the feasibility of a project. Let's say we want to construct a dam. Okay, we cannot just remember resources are very limited. Okay, when resources are limited, it means we need to use those resources wisely. Okay, so we are supposed to assess, we are supposed to determine whether the project will be feasible or will be profitable before we invest the money into that project. So we have got a lot of methods that we can use to assess whether the project will be viable or the project will not be viable. Okay, so we call this investment appraisal. So investment appraisal mainly is concerned with capital expenditure. We are mainly concerned with the capital expenditure on projects, okay, or expenditure on acquiring, let's say, for example, a plant to manufacture, let's say, uh, bread for the whole country of Zimbabwe. This involves a lump sum or large sums of money. So we are expected at the end of the day to determine the profitability before we commit ourselves to such resources. Okay, so we have got two methods that we use to assess whether the project will be viable or not. We have got the quantitative method, number one, and the qualitative method. The quantitative method is where we use numbers. Okay, so today we are mainly going to be concerned with the quantitative method, where we are going to use numbers, figures, to determine whether the project will be good or not. Okay, we've got also another method which we call the qualitative method. This is non-numerical, where we determine, let's say, the level of literacy in that country, where we determine maybe the demographic features, distribution in that country, maybe the political stability in that country. But today, my main focus is on these four methods that I've highlighted. Number one, the quantitative method. Number one, we've got the accounting rate of return, which we call ARR. Then two, we've got the payback period, which we call the PBP. And number three, we have the net present value, which we call the NPV. And the last one is the internal rate of return. Okay, so I'm going to concentrate today on this video, I'm going to concentrate only with these two methods. Okay, so these are quantitative methods, and we are supposed to have our calculators by our side so that we can do the math together. Okay, let's move on. So we're saying accounting rate of return. This method uses profits. Okay, we determine accounting rate of return. We use the profits of the business to determine the viability or feasibility of a project. We use what? This is a very important term. I think you need to highlight that one. We use what? Profits. And profit is calculated using the normal way. Remember, our normal way of calculating profit, we say our gross profit less expenses, then we get our net profit. That's the profit that we're talking of. So in determining of profit, we always use depreciation. Remember, depreciation is part of operating expenses. So this is the only method. Can you hear me clearly on this one? This is the only method that uses profits, and this is the only method that uses what? Depreciation in computation of the accounting rate of return. And usually this accounting rate of return is it comes as a percentage. I think this is we are following what I am actually explaining on this one. So I'm saying accounting rate of return uses profits. So we determine the profits that we are going to make for the duration of the project, let's say for 50 years. Okay, if we have determined the profit, the profit for 50 years, we need to come up with the average of 50 years. So we say profit for 50 years divided by 50 years, then we get the average profit, average annual profit. Then we use that one to calculate the accounting rate of return. So the formula is very simple. We use average profits. Okay, we divide the average profits. In this case, we divide our average profits with the average capital employed, or our capital employed. Okay, but how do we calculate average profit? Let me show you how we determine. Let's say this is the profit for 3 years. Total profit for 3 years is 150 million. All right, This is for 3 years. It's very simple. I think you can actually engage your grade 2, 3 maths here in this case, an average. So we are going to average profit. It's very simple. In this case, we say 150 million divided by 3 years. Okay, this is 3 what? Yes. Okay, so it means we can actually get our average in this case. So 150, we say 150 punch on a calculator divided by 3, this is 50. Okay, so our average, this is 50 million. Our annual average profit, it means on average we get 50 million every what? Every month. Okay, or every year, not every month. Okay, then we are supposed to determine our capital employed. Our capital employed is taken to be 1/2. Okay, 1/2 of the initial outlay. This is the amount that they invested. We call it I0. Okay, I0, which is our initial outlay. Okay, the company actually, in simple terms, the company actually invested 500 million in the project. Okay, which call it the initial outlay. All right, then how do you determine the average capital? It means it's 1/2 of this. Okay, so it's very simple. Average capital employed, it means average capital employed, we are going to say this one, average capital, we say this one divided by 2. Okay, it's 1/2 of this one. Then how do we calculate? We go back to our formula. We are going to say 50 in this case. Okay, average, this is 50. Let's try to follow. 50, we divide 50 by 250, right? 50 over 250. We multiply everything by 100. I think it's very simple for us to get a percentage. Okay, let's divide. This is 50 divided by 250. Then we get 20%. So this answer is very correct. 20% is our accounting rate of return. I think you can actually see this. This is a very simple. I'll give you a task to do, but let me continue to the other method, the PBP, payback period. In using payback period, let me go back to a payback period. I explained this. Okay, okay. Payback period, it uses cash flows. Okay, it uses cash flows. Okay, it uses cash flows. This one uses profits. For profits, I'll use this pie to represent what? Profit. This one uses cash flows, usually the net. Okay, but it uses cash flows. But how do we come up with cash flows? Cash flows it excludes all non-monetary activities. For example, let's say monetary transaction, for example, depreciation, provision for bad debts. So when you are calculating payback period, please be very careful. Payback period does not use profit. It uses cash flows. So cash flows, in simple terms, we want to determine the net cash. If we received $50, then we paid $10. Our net cash flow is 50 minus 10, then we get 40. That's our cash flow. We are not going to say less depreciation. No, no, no. We consider all inflows and outflows, then we get the net. Okay, let me show you how we do it with this example. So we are saying payback period is another. Okay, let me explain what is payback period. Payback period is the number of years that the cash flows, the net cash flows of a business will take to recover the initial investment. We are saying how many years are we going to take how many years are our cash flows going to take to cover the 5 million? How many years are our net cash flows going to take to cover the initial investment of 5 million? That's our payback period. When is the capital going to be paid back, in simple terms? So how do we calculate payback period? We first stage, we determine our net cash flows. If we have our net cash flows, I will show you the computations and how you do it. Okay, so first thing is you determine your net cash flows. Okay, if it's like this, let's say we have got your revenue, you received 1 million, then in terms of expenses excluding, okay, excluding, this is depreciation, right? Yeah, there's a technical issue there. Excluding depreciation. Remember, we do not include depreciation when we are calculating the payback period. We do not need it. We exclude it at all costs. So these are expenses without depreciation. Remember, depreciation is an expense, but it's a non-cash item. So we do not need it. Okay. So we're saying we raised how much? a million, then we expended 0.2 million, then it means the net cash in this case is actually A, this one, minus B. That's how we get our C in this case. Our C is in simple terms, we are saying A, right? A, column A minus column B. That's how we get this one. So we are going to say 1 million minus 0.2, we get 0.8. Then we say 8 million minus 10 million, okay, 10 million minus 8 million, we get 2 million. I think you can actually complete this one. Let's try to do this one again. 15 million inflow, this was our inflow, okay, 15 million was our inflow, and this was our outflow, okay, in terms of cash, okay, our outflow. So we are saying we received 15 million, then we paid 12 million, then the net cash flow in this case will be how much? Oh, thank you, very correct. It would be 3 million. We are completing, we are actually answering the question. Then and we received in 100 million, okay, in 100 million, out 70 million. What do we do? What is our net? In this case, we get what? 70, 100 minus 70, we get 30 million. Okay, I think we have completed, we have answered the first part of the question. Okay, all right. So calculate the cash flows, not cash flows, the net. This question should be the net, to be clear. But even if it comes like that in the exam, when it says calculate the cash flows, we usually need the net. Okay, because all of these, they are the cash flows, but what are the net cash flows? Okay, so we are done with this one. We get 3 million on this one, we get 30 million. Then the question is, say, calculate the payback period. When you want to calculate the payback period, we're saying payback period is the number in years that the net cash flows will take to recover the initial investment. So the initial investment in this project was 5 million in year zero. Why are we saying there is year zero? They purchased a baking machine, right? A baking machine was purchased for 5 million. So in year zero, that's when they do, that's before they start business. It means it's in year zero, right? Year zero is the initial, when it's within their mind, when they're thinking of the project, that's year zero. They do everything in year zero, right? Then they start trading year one. I think it's making sense. So they invested how much? 5 billion. Then we want to determine the payback period. How long will this, in the simple term, the payback period is how long will these net cash flows, how long will these net cash flows take to recover the initial investment of how much? Of 5 million. That's the question. That's how we are supposed to do this one. How long will it take to, how long will these cash flows take to recover the initial investment of 5 million? I think we can actually see it's very simple. It's 5 billion minus 0.8 minus 2 minus 3. Then we have covered it. But let's do it in a accounting way. You prepare something like this, a table like this, okay? This column is not necessary. I think I forgot to delete this one. Okay, let me try to find something to cover it. It's not necessary. All right, let me just cancel this one. This table, this column, ignore this one. It's not necessary. Okay, we just need, I think, these two columns. Okay, so we need this column where you indicate your period, you need indicate your cash inflow, and then your balance, like this. So these are the columns that we need. Okay, so we are saying in this case, okay, let me pause the video, then I change this one so that, let me stop. No. Okay, let me continue with this one. So we are saying when we want to determine our payback period, we are expected now in this case to draw this, and I think I've highlighted in our previous lesson that this column is not necessary. Okay, this column is not necessary. Let me try to find ways of erasing this one. This one is not even necessary. Okay, this column is not necessary. Okay, format it. I want to put it in white. Put it be in white. All right, let me